I'm sure you're familiar with the term adjusted EBITDA, which is only getting more and more adjusted. Your MO needs to be that I want to try and find every single red flag. And you should assume there are red flags. If you look at just the US and Europe, I think energy demand is going to grow 40% plus over the next 2 decades, and grids cannot keep up. So there's going to be a lot of need for financing, energy and infrastructure. I think investors are looking to diversify away from the US, including from a lending perspective. We have to all appreciate the fact that AI and large language models, it's a paradigm shift. You have to recognize that paradigm shift, and I think caution is warranted.
Today's episode is brought to you by CAIA.nxt. Later in the show, you'll hear more about how you can take the next step for your clients with CAIA.nxt's alternatives education courses. But for now, let's get into today's interview. Very pleased today to be joined by Raghav Khanna, Managing Director within Oaktree's Global Private Debt Strategy. Raghav, welcome to Monetary Matters.
Thanks, Jack. Thanks for having me.
It's my pleasure. Raghav, I want to start off by giving you my rough sense of the credit world over the past few years, and you can tell me to what degree you agree or disagree with it. My characterization would be as follows, that for the past several years, credit has been performing extremely well, and judicious underwriting, such as the type that Oaktree attempts to and does engage in, has been performed well and has been rewarded. And obviously there are other judicious underwriters within the credit world, but also credit's been performing so well, whether it's because inflation's been high, because companies' cash flow is so high, or a variety of other reasons. Credit has performed so well that, to an extent, unjudicious lending and perhaps reckless lending has also performed extremely well. And I would characterize that, in my sense, has been true up until the summer of last year, 2020, 25. To what degree would you say my characterization is accurate? And to what degree do you think we might be in a new era where reckless lending is punished, as it has been somewhat over the past few months, and that the ability to judiciously underwrite is going to be a differentiator in the credit world?
Yeah, look, I mean, you make a great point, and I would say I would even go back further. It's not just the last 3 years. If you think about it, right, like certainly private credit, as opposed to high yield or broadly syndicated loans, is a relatively newer asset class, right? Like a lot of managers started off in the early 2000s, but it really took off in earnest post the global financial crisis, right? Because of retrenchment from banks, because of Dodd-Frank and other regulatory pressures. And if you think about it, we haven't had what I would call a real recession since the GFC, right? You had some volatility around 2014-16 with the energy crisis. You had COVID, which was pretty short-lived if you really think about it. And then you had some issues in 2022 where the market was concerned, I think rightly so, for a period of time about stagflation. But then, the market, if you look at kind of end 2021, what spreads were in the liquid credit market as a proxy for risk, and where they were, call it end 2023, they were basically flat over that time period. So we haven't had a real recession. We haven't had anything beyond a dislocation is what I would say. So you're absolutely right that the market really hasn't been tested, especially for private credit, which doesn't have as long a history of showing performance over cycles as certainly IG, but also in the below IG market in high yield and broadly syndicated loans. Now, you are starting to see some of those issues, right, with what you call as reckless underwriting show up in the news, in the media. I'm guessing you're talking about First Brands, you're talking about Tricolor. There was a Saks bankruptcy recently. And what I would say is, one, I don't think this is a systemic issue where I'm seeing a lot of reckless underwriting through the system. I do think these are idiosyncratic issues. And I also think these are idiosyncratic issues which, certainly some lenders managed to avoid completely. And, some were able to stay away from all three of those situations. So I would say that certainly, not just with the benefit of hindsight, but in the moment, there were enough red flags, which each of those three issues, or each of those three issuers, where, to your point about judicious underwriting, if you had done the judicious underwriting, done the appropriate background checks on the founder of First Brands or Tricolor, and done other underwriting, you could manage to stay away from them. The other thing I would say, which is why I'm not concerned that this is a big like asset class issue. Certainly, there are certain managers that I think will be punished more who haven't done the right type of underwriting. Is that if you look at it, asset class level, defaults and like shadow defaults, and we can talk about that, right? Like PIC as an example, it kind of peaked out in 2024. And I wouldn't say it's like tremendously better, but the kind of the path is getting better in terms of the what I would call like risky assets in the industry overall.
That's really interesting. Thank you. Yeah, you at Oaktree and other folks at Oaktree are always constantly assessing risks. And for example, last summer, I was lucky enough to have on Wayne Dahl from Oaktree, and he talked about how when the tariff thing happened in April of last year, he and all his colleagues, sat around the table and talked about, okay, what's the exposure to these companies? What's our exposure to companies that have tariff exposure? And obviously, that was a very good practice to do. But I don't think it's fair to say that that the tariff risk arrived in credit. I know in the stock market it
Mhm.
certainly hasn't. However, when it comes to this first brand issue, I do know because chairman of Oaktree, Howard Marks, wrote in November a memo called "Cockroaches in the Canary Coal Mine" or something like that.
Yeah.
That basically the implication was that Oaktree did a lot of work on first brands in the summer. And again, the implication was that they exited that portfolio and avoided that risk. So, can you tell us just about, if you can, any specifics on the potential red flags that you or other colleagues saw within First Brand to avoid this massive default, and also just generally, what is the process to avoid those red flags, and what are red flags that you think should be avoided in the past, but also in the future?
Right. So you're right. Like that was a pretty interesting memo from Howard. And um, big picture, there were three red flags that if a manager had like picked up on, frankly, any one of those three, they would have stayed away from the first brand situations. And if you picked up all three, you certainly wouldn't go anywhere near that company. The first red flag was, for the benefit of your listeners, first brands, they make aftermarket auto parts, right? Like windshield wipers, brake pads. Not stuff that I would say is like highly R&D engineered or has massive barriers to entry. It's certainly not like an Apple or like a Facebook with like a very incredibly strong moat. So given the barriers to entry, you would expect that their margins would be in line with other similarly sized businesses in similar industries. And their margins were several hundred basis points higher, at least the way they presented it. And then again, you kind of do your basic like, MBA first year kind of thinking. You're like, well, if the barriers to entry aren't incredibly high, if the moat here isn't a big moat, then there's no reason why they should be earning these, call it excess margins. So that was issue number one. Issue number two, which I'm sympathetic to some managers in how they did not see this, but for managers who invest in both liquid credit and also private credit, they were able to pick up on the fact that this company was constantly raising financing in different markets that normally the participants in those markets don't talk to each other. So as an example, they would go to the broadly syndicated loan market, which is dominated by CLOs, raise financing there. They would then go to the private credit market to raise a private loan against certain assets. And then they would go to the asset-backed finance market to raise financing against their receivables or their inventory, right? And for managers who are in all three of those markets, they were able to actually see that, wait a second, one, this company claims it has incredibly high margins and a lot of cash flow. But second, it is going and raising financing from these different markets. And it's almost deliberately targeting markets that for most managers don't talk to each other. So no one can see kind of the full picture. So that was red flag number two. And red flag number three was frankly just the founder. The fact that the senior management team was a founder and like a bunch of his family members, no professional like outside management. If you did a background check on the founder, Patrick James, you would see a lot of red flags there as well. So from a governance perspective, if you did that background check, you would say, well, this is not a person that I'm comfortable lending to. And then, for those managers who were able to put all of these three red flags together, they were able to see that, clearly there was something very deeply wrong with the situation.
Thank you, Raghav. So all of those three red flags, would it be fair to say that for someone who's just looking at, the six statistic checklist of debt to EBITDA and other debt coverage ratios that did pass that initial sniff test, but that there were additional factors to be considered?
That's absolutely right. When like in the credit business, our job is negative selection, right? We don't have the upside of equity. If you're making a loan, even at rates right now of like high single digits, you're really looking at a 1.2 to 1.3 times MOIC, because these loans usually repay quickly. So it's really about like managing your losers or avoiding them completely. And so certainly when you're doing that as part of the underwriting, you do look at the KPIs, you do look at the metrics, you do look at what is leverage, but then you also start digging deeper into things like, well, I'm sure you're familiar with the term adjusted EBITDA, which is only getting more and more adjusted. And how different is that from what the cash flow statements show? So you then have to look at, well, it's not just leverage that I'm looking at and the debt service coverage ratio that I'm looking at, or the LTV based on some implied, sometimes made up number, by the way, by the bank or the borrower, but then really start to pierce into the three statements: the balance sheet, cash flow statement, and the income statement, to really get a fuller picture of what this business does from a cash flow perspective. Because in the end, as we like to say, you don't eat EBITDA, you need cash flow. And then beyond that, it's all of these, other non-KPI related things that I talked about, which is you have to spend time speaking to suppliers, you have to spend time speaking with customers. The other red flag that I forgot to mention with First Brands is if you spoke to their suppliers, they would consistently complain about the fact that they would be late on payments and ask for very aggressive terms, which were inconsistent with the rest of the market. You have to speak with former employees to try and turn up red flags there. If anything, your MO needs to be that I want to try and find every single red flag, and you should assume there are red flags. And it's only at the end of that underwriting process, including both the KPIs, but also some of these like more subjective questions that you have to raise, including governance, that you can be comfortable or not comfortable making a loan.
Thank you, Raghav. So I'm quite familiar. I see all the time how adjusted EBITDA figures do sometimes bamboozle investors in the equity market. Could you tell us how they do lead to some confusion, perhaps in the credit markets, and how you try and avoid that?
Yeah, so adjusted EBITDA, it's a concept that's been used for several years, going back a decade. And initially, it was a somewhat innocuous term because predominantly private equity sponsors would use that to normalize for truly one-time events. Let's say they close a facility which was underperforming. It cost them some severance and some costs to relocate equipment. Truly once in like 5 years. And they would say, hey, this doesn't reflect my performance, my run rate performance, so let me add those costs back. But over time, the adjustments that are being added back to GAAP EBITDA have become one more aggressive in the sense of the number of things that are now being captured and added as an adjustment, and they're becoming more reoccurring in nature. So when you start seeing adjustments which are sometimes 40, 50% of GAAP EBITDA, and then if you start seeing those reoccurring, like persisting year after year after year, talking about red flags, that's again a red flag. And as a manager in credit, again, where you have limited upside and a lot of downside, it behooves you to start by looking at the cash flow statement and build up to what I like to call cash EBITDA. And then look at how different is that from the adjusted EBITDA figure. If if managers just did one thing, if they started lending on the basis of a cash EBITDA figure, perhaps normalized for truly one-time events like a factory closure, as opposed to relying and levering off an adjusted EBITDA, I think that change in behavior, just that change in behavior itself, will lead to much better default and recoveries for credit managers.
Earlier, you referenced shadow default, so PIK or payment in kind. So, in other words, credit investors, lenders being paid not in cash but in debt, or being paid, the right more bonds. Uh, Describe the trend, that rise that you saw over the past few years. And did you say earlier that that rate peaked actually in 2024? Is that what you said?
Yeah, so it peaked in 2024, and again, I wouldn't say it's down like a lot. Where I would say, hey, there's no problems here. Like let's move on. But it is like moving in the right direction. And a pick or like shadow defaults. What I mean by that is, and this is frankly one of the critiques of private credit, and I think it's a fair one. Uh, Whereby because it's private, because it's bilateral, where like there's obviously one borrower, but there may be like a handful of lenders on the other side, um, and there is sometimes incentives on both sides where there are issues with cash flows or underperformance of the business. There are sometimes incentives on the side of the private equity sponsor that owns that borrower, but also on the part of the lender who wants to manage how many defaults they show, to have a agreement where they say, look, there's not enough cash flow to service the debt. Let's say the cost of debt is 10%. Why don't we do this? Why don't we reduce the cash portion of the 10% to, making up numbers here, 2%? And let's say we pick the remaining 8 points every year. The incentives are obviously clear. You can still show this as not a defaulted loan from a lender perspective. But for all intents and purposes, if you cannot service your cash coupon and can only service 2% out of 10, to me, that's a default. So when we look at the health of the industry, the health of the asset class, we look at one, just non-accruals, which are true non-accruals. But then second, we also look at which loans were originally designated as cash paying loans and are now being designated as PIK loans, and how much of the coupon has migrated from cash pay to PIK, to look at like what is the overall health of the industry. And that's probably the portion that I think is least understood by the market.
Yeah, I think it is not understood. I was not familiar with it, so I got to ask a follow up question just so I can understand. So you're saying that the the principal at the end of the day is still going to be paid in cash, but the coupon that you're getting, a percentage of it is going to be paid in cash, a percentage of it is going to be paid in additional debt, and that's what you're describing.
Yeah, but it's actually slightly worse than that, in that there is a hope. Like again, using my example of a 10% cash coupon being split into a 2 cash and 8 PIK, the 8 is really, think of that as a hope note. Because at the end of year one, if you have $100 of debt and 8 points of PIK, at the end of year one, your new principal balance is 108. So the reason it's a hope note is, if there's a situation where the borrower cannot service $100, certainly the expectation that they will service $108, I wouldn't have that expectation. And so I think of that as kind of a hope note where, in some ways, it's a classic kicking of the can. You're just hoping something miraculous will happen. Either someone will come in and buy this business at a massive value, or if it's a cyclical business, you're hoping that the cycle will turn in favor of the borrower. But you're just hoping. There's not necessarily a strategic plan. And I think of that PIK portion as a hope note.
And is the maturity of the PIK note often the same as the maturity of the principal?
Yeah, no, it is. It's exactly the same. The other thing we look at, by the way, is you make a good point, which is what's happening to maturities. Are maturities being extended? Now, if a loan is cash paying, but the maturity is being extended, it's usually not a sign of an issue in someone's portfolio. If the maturity isn't extended, but the coupon is turned partly into PIK, that is an issue. I think the worst sign, the biggest sign of an issue in a portfolio is when you have both. When you have a maturity extension and you have an agreement to convert some or all of the cash coupon into a PIK.
And those maturity extensions, I know for a fact that they happen because company A had a loan either to the leveraged loan market in the high yield bond market or in a private credit lender, and then another private lender comes in and refinances that deal. I know that is maturity extension, but were you hinting at a maturity extension between an already existing borrower where there's a little bit of a modification? In the banking world, they call that a modification.
That's exactly right, Jack. So the lingo in like private credit is slightly different. Like the first instance you described where a new lender comes in and refinances another lender, we just call that a refinancing. So that's like, totally par for the course. There's no issues there, because a new lender, again, assuming, to use your word, a judicious lender is exercising caution. They're re-underwriting the business and saying it's a good business. The issue or the concern that I'm highlighting is exactly what he talked about, which is a loan mod, where the existing lender, not a new lender, existing lender, existing borrower agree on a maturity extension, and if combined with a mod on the coupon as well, that's clearly a sign of, okay, there's some stress in this business.
And so you said that the rate of PIK had actually peaked in 2024 and is down modestly, not huge, but modestly. In terms of the rate of loan mods, what are you seeing there?
So again, like, when we look at shadow default rates, we kind of combine, all of these like modifications, to kind of look at one headline number, and the stress in the system is getting better. By the way, one important note is, I would make a distinction between loans made in 2021 and loans made in subsequent years. And the reason is, some of these loan mods, by the way, that we're seeing are actually good businesses. But what's happened is a lot of these, good businesses took on debt in 2021 when rates were zero, and there was an expectation that rates would stay at zero indefinitely. And so, those 2021 vintages have pretty high leverage for where rates are today, not for where rates were back in 2021. So, a lot of times these businesses were levered at 6.5 times. Cost of debt was LIBOR back then plus, let's say, 500. So LIBOR floor was 1%, so 6% cost of debt. So for obviously peaked at 5.25. So in some cases the coupon went from 6% to 10, 11%. And these businesses, the underlying borrowers, in some cases, they've like continued to grow at a modest like 2-3%, which I would say is okay performance, not great performance, but certainly not underperformance. But it's just the cost of debt has gone up so much because these are floating rate structures that the earnings haven't grown in line with the massive increase in cost of debt. So a lot of the issues we're seeing in the asset class in the industry is actually centered around that 2020 and 2021 vintage. I would say subsequent vintages are actually performing very well.
That's interesting, and yeah, you framed it in kind of a negative that, okay, a company was paying 6% and now it has to pay 11%. But as from a credit investor perspective, that drastically enhances the return. So it is a trade off.
Yeah, no, it's a trade-off, but from a credit manager's perspective, you have to balance, and a lot of your questions were kind of lead up to this, which is you have to manage your coupon that you're collecting, which is great. It goes from 6 to 11 with your losses. If in the change in the interest rate regime, you're going from 6 to 11, but then you're starting to see a lot of losses because you were not careful about which companies you made loans to, and you've made loans to companies that don't have pricing power, for instance, that can increase pricing to accommodate this now higher interest rate. Well, you get a lot of coupon, but then you kind of give it back on the other side through higher losses. So the trick in really kind of any cycle, whether it's an economic cycle or an interest rate cycle, is to make loans to companies that you think can operate under different types of business and macro conditions, such as tariffs. You mentioned tariffs, right? Like that's another kind of big, although short, shock to the system. Interest rates was a big shock to the system. A recession, which again, we talked about it, but we haven't seen a real one in a long time, would be probably the biggest shock to the system. So as long as you're making loans to, good quality companies, you may have some kind of, bumps in the road, you may have some issues, but generally these businesses have enough pricing power, against tariffs or interest rates where they can manage and they can be okay. And then if you can get that higher coupon and also manage losses, that's the best of both worlds.
I want to ask you about the general ecosystem. You've talked before about how there's a merging between the world of liquid credit, high yield bonds, and to some extent also leveraged loans and private credit. Talk about that, the blurring of those worlds, the merging of those worlds. And then I'm also curious about the relationship and the ecosystem between private credit lenders, such as yourself, and the sponsors, so the private equity companies that own the equity of these companies, whereas you would be owning the credit of those companies.
Right, right. That's a pretty interesting topic. So happy to talk about that. But maybe before that, I'll spend a minute just on private credit because it's sometimes confusing what is private credit and which parts compete with the liquid markets and which ones don't. So it's obviously, and as an asset class, it's grown a lot. It's about $2 trillion in size in just the below IG part of private credit. That's my focus, but the IG part is like multiple times bigger. Now, within below IG private credit, the biggest piece is senior direct lending. Now, senior direct lending, when we talk about how private credit competes with liquid credit or broadly syndicated loans, it's really the senior direct lending part of the private credit universe that competes with broadly syndicated loans. And that's where you are seeing conversions. You're seeing conversions across leverage. You're seeing conversions across covenants or lack thereof. And you're seeing conversions across credit agreement terms away from covenants. Where you haven't seen conversions is that you still have 150 to 175 basis points premium in senior direct lending versus broadly syndicated loans. And that's warranted. Like you need that premium because obviously this is an illiquid asset class. So investors, LPs need to be paid for that illiquidity premium. But as broadly syndicated loans have tightened from their 2022 wides, senior direct lending has also tightened pretty much in lockstep, which is why these are like very much adjacent asset classes. They're predominantly used by private equity sponsors for new LBOs. But there are other parts of private credit where there hasn't been conversions, and I don't see that happening anytime soon. So the other flavors are, there's asset-backed finance, there's real estate debt, there's infrastructure lending, there's non-sponsored lending. And so some of these areas are, previously were niche, but they are growing pretty rapidly in some cases, such as infra debt and asset-backed finance. But they have a high degree of complexity, either from an underwriting perspective or a structuring perspective, and oftentimes both, where the barriers to entry, if you will, to make loans in these sectors in a risk-controlled manner is much higher. And so in these areas of the market, you will sometimes get 250 to 350 basis points premium over broadly syndicated loans. Now, the interesting thing is, if you kind of push the thinking, senior direct lending will kind of move in lockstep with broadly syndicated loans, but you still get like a 150 basis points premium, which is okay. But if you can create a portfolio where you can combine all of the elements of private credit, not just senior direct lending, and you have senior direct lending giving you a little bit of yield premium, but then you combine all these other areas of private credit to create a very diversified portfolio where you're getting 300 basis points more than BSLs. Well, now you have a portfolio which is one, very diversified, but second is generating, call it 200 to 250 basis points over senior direct lending, over broadly syndicated loans, excuse me. So that's like what's interesting and what's been interesting to LPs. In terms of relationships with private equity sponsors, I think the other trend we're seeing is private equity sponsors want managers that do not just everything in private credit, where they can lend to a regular way LBO, but they can also lend against certain hard assets through real estate debt, or lend against some other assets that they have. They want managers who have all those capabilities so they can be a one-stop shop. But the other thing they want is they actually want managers who can do private credit, but also liquid credit. Because to your question, right, like in senior direct lending, you are seeing that convergence with broadly syndicated loans. There's about $60 to $80 billion of paper annually that moves from the broadly syndicated loan market to the private credit market and back and forth. And they want lenders who can offer, like, again, a one-stop solution across not just everything within private credit, but also liquid credit versus private credit.
I hope you're enjoying today's episode. As many of you know, the asset management game is changing. Increasingly, alternatives are eating into both stocks and bonds and becoming staples for all types of portfolios. With over 25 trillion already in alternative investments and 20 trillion more projected in the next few years, clients expect more than surface level knowledge when it comes to alternatives. That's where CAIA.nxt comes in. It's a self-paced learning platform designed for financial professionals who need to understand and speak credibly about hedge funds, private equity, private debt, digital assets, real estate, and more. With CAIA, you'll learn directly from the leading allocators and alt managers shaping today's capital flows. So what you learn today, you'll use in your next client conversation. Whether you're an independent advisor or you're trying to get ahead of your peers in a larger organization, CAIA.nxt gives you the edge to stay relevant. Visit the link in the description to get 10% off and start mastering alts for your clients today. Be future ready with CAIA. Thank you for that. That's really interesting. And in terms of the relationship between private credit lenders and the private equity sponsors, how important is the relationship, and does the relationship and perhaps the scale and size and pedigree and background of the sponsor take into account? Like, let's say, for example, I'm lucky enough to have a giant private equity firm, and I've delivered extraordinary returns to my investors, and to lender companies who have lent money to my companies, I have historically not defaulted on that as well. How much would that impact your analysis, if at all, versus just the pure raw underlying fundamentals of the company?
Yeah, look, I think you make a great point, and we didn't talk about this, but if you think about, Jack, you or I, like buying something and getting financing from a commercial bank, right? The commercial bank, like a Wells Fargo, will look at, well, what asset are you buying? Are you buying a primary home versus a vacation home? There's a different risk profile of the asset you're buying, but they will also look at, yours or mine FICO score. And what you're saying is, well, if you think about the corollary to, private credit, you have to look at the fundamentals of the borrower, the asset that the private equity sponsor is buying, but you have to quote unquote look at, well, what is a FICO score of the buyer, which is a private equity firm? Now, obviously, there is no such concept, right? Like, there's no number that we follow or track, but there is a subjective FICO score that you have to look at for the private equity sponsor that's actually doing the buying of the asset, and you have to look at their track record. And again, I think if you're a manager who's been doing private credit or direct lending for a long time, because there is no published FICO score, this knowledge is very proprietary and built up over many years and decades of relationships with these private equity sponsors. In terms of, you're absolutely right, like, how do they behave? If there's an air pocket, do they walk away, or do they put in more equity? Do they engage in what's known as, and becoming increasingly popular, an LMT, or a liability management transaction? Do they pit creditors against each other? Do they take assets away? So that kind of behavior is absolutely part of the underwriting and the part of the questions that private credit managers should be asking on a deal by deal basis.
And the LME or LMT, liability management exercise, I thought that was creditor one having a loan to a company, and then creditor two comes in and sort of takes that deal in a way that's unfavorable for creditor one. But you're talking about the actual equity holder, the sponsor, doing that. Describe what that might look like and why that might be an adverse scenario for a lender.
Yeah, so yeah, you're not wrong at all, by the way, Jack. It is like creditor on creditor, but in order for a liability management exercise to happen, it has to be initiated by the management team, the board, and ultimately the equity owner, which is a private equity sponsor. So, two common examples of LME. One is being the sponsor, use the lack of protections in the credit agreement of the loan that you had raised when you did the LBO, to move assets, specific assets, away from the collateral package of the incumbent lenders. And then, to your point, either an existing, like kind of chosen creditor or a new creditor, more likely, comes in and provides financing against that asset that has been moved away from the collateral package of the other lenders. So now, obviously, as an existing lender, your collateral package has changed, it's gone down, it's declined, and so any recovery you were hoping to get will be lower and likely will be a restructuring. The other common path is, again, initiated by the equity, where they say that they will basically get to the same place, but through what's known as an up tier, where they will take, again, a chosen group of creditors and move them higher in the capital structure and leave the other creditors behind in the original part of the capital structure. So again, now the capital structure has been reoriented in a way where if you're not part of the chosen group, your recovery is going to be much lower. But it takes a willing lender, either an existing or a new one, and a willing private equity sponsor to actually engage in something like this.
Okay, thank you for clearing that up. That's interesting. And Raghav, how does it feel, or what's the experience like, or does this happen at all, of the private equity sponsors who, I'll just explain the background for our audience here. They in general have very high on paper returns. You use the term MOIC, multiple on invested capital, but in terms of the capital that they've delivered back to their LPs and investors in terms of dividends, that has been a little bit lacking, and there have been widespread headlines about that fact. And so they're eager to deliver cash to their shareholders and to their LPs, their investors. Talk about, is there any sort of competition for cash flow, and does it ever? I know a lot of there are a lot of distributions from private equity, and I know there are a lot of payment in kinds in the creditors to those private equity companies. But does it ever happen at the same time? And what's the experience like of if it does happen, of being told, oh, I can't pay you back, while at the same time the equity holder is actually getting a distribution?
Yeah, that almost never happens.
Okay.
So even though there has been certainly loosening of terms in the credit agreements of both broadly syndicated loans and senior direct lending, there are certain things that are just like sacred. And thus far, thankfully, the market, the participants in the market have not given up on those, what I would call sacred rights. And one is, thou, the equity, doesn't get paid before the lender gets paid. Now, of course, there's always like some level of distributions that are allowed. The equity may have to pay some taxes and whatnot. But in general, you don't see scenarios where a company which is underperforming is also, somehow using its cash flows to pay out dividends and enriching the equity. What you do see, though, is there are some high-quality companies owned by private equity and high-quality private equity sponsors who say, look, we have 4 turns of leverage today. We've actually performed really well. We had 5 turns of leverage when we did the LBO. We've reduced leverage. We ran a process. We hired Goldman Sachs and we ran a process. And we got bids which were 10, 11 times. But we think if we can hold on to this asset for 1 more year and do X, Y, Z things, we can get 13, 14 times. In the meantime, I have pressure from my LPs, as you just described, to return some capital. So would you, the existing lenders, give me 1 turn of additional leverage so I can make a one-time distribution to my LPs and show, good DPI? And in that case, you say, okay, this is fair. They did perform. They delevered. I have this sheet from Goldman Sachs that shows me that, they can clear 10, 11 times. So taking leverage up from 4 to 5 times to pay a one-time dividend is not that objectionable.
That makes sense. It's good to hear that some things are still sacred in the credit markets.
Mm-hmm. Yeah.
When it comes to a few things, 2 years ago, maybe 3 years ago, I think the following things were unambiguously true about the private credit market. Number one, recovery rates were higher. So if a high yield company defaulted, a company that had a high yield bond defaulted, that recovery rate would be X. If a different company defaulted to a private credit loan, that the recovery rate was often higher than X because the covenants were stronger. And the the second point is following that the covenants were stronger than they were in the high yield bond market and the broadly syndicated loan market. So those two things were true. And then also I might say that at least in the regulatory community, there was and I've heard this directly, that private credit is good. The migration of credit risk from the banking system to the private credit ecosystem outside the banking system, it's good because it's not in the banking system and it's not levered. I know, just looking at some fundraisings in terms of private credit funds, I'm not talking about anything your firm has done, but just that often there is a little bit of leverage in there. So in terms of those three things, can you talk about just the transition over the past several years of recovery rates, of covenants, and also perhaps leverage of the underlying private credit fund?
Okay, so taking them one by one. So recovery rates in private credit, and in private credit, you typically get covenants with like smaller businesses. As you get into really large businesses, 150 million, 100 million EBITDA or higher, where again, you start to think about the adjacency between the broadly syndicated loan market, which has no covenants, by the way, no maintenance covenants, and the senior direct lending market, because they are converging. They're also converging from a covenant perspective, in that there are no maintenance covenants in those truly large companies that can straddle either the BSL market or the senior direct lending market. When you look at companies that are smaller, let's say 50 million of EBITDA or 60 million of EBITDA, that company is not big enough to straddle the direct lending market and the broadly syndicated loan market. So they only have like one market they can access. So there, in those type of size, and certainly as you get even smaller, you start to see maintenance covenants, and as you get smaller and smaller, you as a lender obviously need more protections, because arguably a smaller company is more susceptible to issues in a recession than a larger company, right? So that trend hasn't really changed. The only change I would say is, again, as senior direct lending as an asset class is getting bigger and bigger and is willing to finance larger and larger companies and provide financing as big as $5-6 billion, it's competing head on with broadly syndicated loans. So you've seen a convergence in terms of covenants there. In terms of recovery rates, I would say you still get slightly better recoveries in private credit, but with one notable nuance, which is it's not because private credit recoveries have gotten better over time. If anything, I would say they're flat, but broadly syndicated loan recoveries have gotten worse. And the reason is, again, this new thing of liability management transactions. So, historically, BSL first liens would recover 75 cents. Now they're 40 to 45 cents for a first lien. And again, nothing has changed except that, you are just lower in the capital structure by the time the company actually files or, restructures. So that's on covenants and recovery. And I apologize, Jack, what was your other question?
Leverage, how, at least I don't know whether this was ever true, but several years ago, I know top former regulators would say, we welcome the migration of credit risk from the banking system to the private credit firms because it's not in the banking system and it's not levered. But I have personally observed that leverage is a little bit more common now.
You're right. Like, especially in the senior direct lending part of the market, you get typically all of the managers, when they're raising funds and accounts, they're levered. In certain like other areas of private credit, because the unlevered yields are so high, you as a manager may not need leverage, or the LP may not want leverage at all. But again, focusing just on senior direct lending, most of those managers do lever, and they use about 1-to-1 times leverage. So $1 of debt and $1 of equity. So you would describe that as, well, you lever basically 2-to-1. You have $2 of assets, $1 of equity. The reason I think, and again, I'm certainly biased as a manager in private credit, but the reason I think that's better than banks is because, I'm sure you know this, banks are levered 10-to-1. The other benefit of, from a kind of societal and economy perspective for having these loans in the non-bank sector is that you saw this with Silicon Valley Bank, right, and Signature Bank, is that managers are raising closed-end funds, or they're raising evergreen funds where they have the ability to control redemptions. So you have long dated capital to support long dated assets because private credit loans are typically 3, 4, 5, 6 year loans. With banks, you have an asset liability mismatch in that the biggest source of financing is deposits, checking deposits, saving deposits, time deposits, which are very short dated liabilities, financing what are very long dated assets. So both the leverage is lower in the non-bank sector, but then also I think just as equally important, there's a true matching of assets with the liabilities.
Thank you, Raghav. So, with regards to sectors, I think I and maybe some people watching, they think, oh, private equity, they own a lot of industrial businesses, the steel mills. And, certainly that was true, and to some extent it is true. But I think a lot of private equity companies own a lot of software businesses,
Mm-hmm.
and as a result, a lot of private credit lenders, or direct lending to those sponsor-backed companies, make loans to software businesses. And Raghav, I would be, very reluctant to take some minor move in the stock market and ask a experienced credit investor such as yourself about it. But there is the bid for software companies in the equity market is definitely down on the
Mm-hmm.
fear that all these companies are going to be vibe coding their own apps, so who needs software names. And then there was another not Oaktree but another high profile credit shop that actually came out with I think they said they're underweight software as a sector. So just your personal view, just where do you think of the view that software is going to be challenged, as well as particularly lending to software? Is it as a favorable risk reward as it was several years ago?
You make a lot of very astute observations, including the fact which I think many people don't realize that, to your point, Jack, private equity firms, you expect them to be buying healthcare, industrial businesses, and they are, but they're certainly very heavily indexed to software, especially SaaS, software as a service. Um, I think you make some good points, and I think we have to all appreciate the fact that AI and large language models, it's a paradigm shift. And I know there's a lot of questions about what is the ROI on this spend and like the trillions of dollars that on data centers and whatnot. But regardless, I think it's a paradigm shift. And I think again, as a lender, capped upside, a lot of downside, you have to recognize that paradigm shift. And I think caution is warranted. And I think there are three concerns that the market has, and we as lenders have around SaaS business, software as a service businesses. One is, maybe not right now, we're not seeing it, but certainly I think we will see it. Customers will start to move their spend away from the traditional SaaS businesses to AI native companies. Second is, if you think about SaaS businesses, their revenue model is seat based, which is how many employees at XYZ firm are like actually using the software. They charge them on a per head or per seat basis. And I think you're going to see disruption, potentially a lot of disruption to that revenue model. Because that revenue model, under the threat of agentic AI, will have to move to more of a consumption or more of an outcomes-based model. So, customers of software companies can actually see a real ROI as opposed to paying on a per seat basis. And then third is, vibe coding. You're right. I mean, I think the switching costs away from software, incumbent software, is lower now because AI can, create software and create lines of code more easily. So I definitely think, caution is warranted. I think software and SaaS businesses, I think there will still be plenty of winners. The ones that I think are going to win are the ones that can show that they have a high ROI and have a lot of integration with a company's overall IT stack, and then finally are used kind of day to day, like something like Bloomberg. It's something that I use, rely on very heavily, and you're gonna have to rip it away from my dead hands. So the daily usage and the level of integration into a company's and an employee's workflows, that matters a lot, because think about it, right? Like software is not just lines of code, it's also the packaging around it. It's also the delivery of that software, the user interface, and then the customer support. It's all those elements that have to come together. So there will be companies that, especially from a lending perspective, will be okay. I think you make a good observation that there are question marks around the terminal value of some of these businesses. You see Adobe, you see Salesforce, their multiples have gone down a lot because of questions around the terminal value. The kind of the nice thing from a lending perspective is if you're lending at 30, 40% loan to value, as long as you didn't get the original value completely wrong, that can go down 20, 30%. It will hurt the equity, but you as a lender should be okay.
Thank you. I now want to ask about the parts of private credit that are not direct lending. So asset-backed finance, non-sponsored deals, so lending to companies that are not backed by private equity, and then real estate deal. What is those three worlds kind of look like? And would you include real estate loans as asset-backed finance, or is that something different?
It's typically different. So asset-backed finance, think of these as, again, you're not lending to a single corporate like a software company. You're lending against a pool of assets. So think of it as like loans, leases, receivables is kind of what your assets are. Now the nice thing is that the collateral itself, the assets you're lending against, they themselves are cash paying, self-amortizing assets. So you get paid down very quickly, and you basically as a lender take a lot of your basis off pretty quickly. That's from a structure perspective. From an end market perspective, you can create asset-backed finance deals in all kinds of different sectors. You can do it with autos, you could do it with consumer loans, you could do it with equipment leasing. So that's the nice thing about asset-backed finance is one is the structure is very good in that you are being paid down very quickly. But then second, you can create a lot of diversification across end markets. That's been a pretty big area of growth, certainly in the IG part of the market, but also in the below IG part of the market. And the reason is, those are areas that banks are stepping away from and have been pretty dramatically. In some cases, just selling off whole different, whole like business segments. So that's been an area of growth. The other two areas you mentioned, so one is non-sponsored lending. The biggest area of growth for us, at least, is life sciences. Life sciences is a very highly specialized area of lending. You need a lot of subject matter expertise. It's also interesting from an overall multi-strat private credit portfolio in that life sciences is acyclical, right? Like you're not tied, like the performance of your drug is tied to the performance of you as a management team and your R&D team, but it's not tied to the overall economy. So that's an interesting segment. And the last one is, where I think we're going to see a lot of growth is energy and infrastructure. I was listening to Fareed Zakaria over the weekend, and he was talking about, I don't know if you saw this, he was talking about the fact that a 5-second AI-generated video requires 3.4 million joules, which is the equivalent of running a microwave for an hour.
Wow.
And look, if you look at just the US and Europe, I think energy demand is going to grow 40% plus over the next 2 decades, and grids cannot keep up. So there's going to be a lot of need for financing energy and infrastructure. And there's just a lot of things that are happening in our economy which are changing, including obviously AI, but also just general electrification. And so I think that's the other area that's very interesting. The last one I'd mention quickly is away from US senior direct lending, Europe and Asia, developed market Asia are very interesting. And it's for two reasons. One is, this shouldn't be controversial, but I think investors are looking to diversify away from the US, including from a lending perspective. And then second is, you don't get a huge premium in Europe or Asia. It's call it 50 basis points in Europe and 100 basis points in Asia, in developed market Asia, markets like Australia or Singapore. But the nice thing is, those markets are early enough where some of the things you asked about, maintenance covenants, you get them. LME protections, you get them. Leverage is typically lower. LTVs are typically lower. Docs are just much, much better. So you get a slight premium in pricing, which doesn't look like it's big enough. But on a risk-adjusted basis, I think you're getting a very good pricing both in both those markets.
And that 50 basis points or 100 basis points premium in Europe and Asia, is that on an hedged basis or an unhedged basis? Because I know from my interview with Wayne Dahl of Oaktree that at least for dollar investors, Oaktree always or almost always hedges the currency risk.
Correct. Yeah. So that's on an unhedged basis. So then you obviously pick up a little bit on the hedge as well. So, but you're absolutely right. Like Europe is pretty interesting. The other nice thing in Europe is, especially in Germany, there's been like a massive regime change. They've lifted their fiscal brake. and not seeing it necessarily in like full year 2025 numbers, but you start looking at uh, uh, higher velocity KPIs about the economy. I think Germany and broader Europe, some of the like Trump administration noise aside, I think is going to have a lot of growth and a lot of interest in private capital from lenders.
Thank you. Raghav, earlier you said something to the effect, I'm going to paraphrase, that the non-direct lending parts of private credit, so asset-based finance and non-sponsor lending, that you said you didn't expect those spreads to compress anytime soon. Could you tell us a little bit why you said that?
Yeah, it's because these areas of lending, uh, they require a lot more expertise. Again, from either a industry perspective, like infra and energy, like you cannot be a generalist, right? You have to have a lot of subject matter expertise. Same thing with real estate debt, or there's a lot of structuring complexities, such as in asset-backed finance, that you also need, and you need to have that over multiple cycles to be able to do those in a risk control way. That's different from U.S. Or senior direct lending, where again, the barriers to entry in looking at a business services business, which is providing janitorial services, that's very different from a very complicated, life science deal or an infra deal where there's a construction element to it, or a asset-backed deal where you have to have a lot of structural protections. So the barriers to entry in those areas are just much higher. The other reason why you should have persistently higher spreads in those markets is those deals take a lot more time and effort to be able to underwrite. If a direct lending deal takes, let's say, 2 to 3 weeks to diligence, some of these more niche areas could take, 6 weeks, in some cases 6 months to diligence and negotiate. And so the return on time is actually quite poor. And so, in order to compensate that, like you need and you get a much higher risk-adjusted return because the return on time is poor.
That makes sense. Raghav, my final question for you is, as you know, there have been several, I guess, financial service providers, as well as one asset manager that, but in this instance, it's not asset manager, is trying to index and connect all the data points of all the private credit lenders. So, Oaktree has its, I'm sure, all these internal docs and all the relationships and all this data. They're saying, we're going to now do that so everyone can become a private credit lender, and there's going to be so much more transparency in the private credit markets. How optimistic are you that that is materially going to happen and be a real change over the next several years? And how might that change the process if it does happen?
Sorry, Jack, could you share a little bit more? I'm not sure what this is.
Oh yeah, sure. Like MSCI and BlackRock
Okay.
and S&P are saying, we're going to not just do ratings on, and Moody's do ratings on private credit deals, but we're going to have an index so that everything is trackable and basically increase transparency. If if you don't know what I'm talking about, then that concerns me because maybe I'm just completely wrong.
No, I have heard about that. So I think, look, I think greater transparency is a good thing. Because again, as I mentioned, like this critique about private credit not being transparent is a fair one. But I think where you start to see transparency will probably start with the private IG market, and the reason is these corporates will almost always have like public corporate bonds. So from a tracking perspective, from a ratings perspective, it's easier to create an index or a shadow rating for their private loans that they might be doing. Oftentimes, these companies are also publicly listed, where the equity is publicly listed, so they have to file Qs and Ks, right? So if I were to track and like create a database, right, like it's much easier for me to do it for private IG issuers because they also have public IG issuance, and they have all of the financials out there on the SEC.gov website. I think it's harder to do with below IG private issuers because oftentimes they don't have a comparable rated bond or loan. There is no rating that you can like point to already, and then the financials are not available. Like you have to be a lender, an existing private credit lender to access those financials. So there have been other ambitious things as well, such as trying to create a trading market for private credit loans. I'm a little less confident that any of these initiatives will actually take off in at least the below IG part of the market.
That's interesting. And in investment grade private credit, that refers, I believe, to two things. Number one, a private credit loan that has been rated investment grade, or number two, a loan to an entity that has publicly traded bonds that are themselves investment grade.
Yeah, and that's a good nuance you point out. I'm talking about the latter.
Okay.
Where a company already has a rating and it has something you can point to and say, okay, this is the spread for this company for a liquid credit, and then you can say, okay, well, am I getting properly compensated for the same credit risk, but in an illiquid instrument? Am I picking up that illiquidity premium?
That makes sense. Raghav, thank you so much for joining us.
Thanks for having me. I appreciate it.
Thank you so much for joining, Raghav. Thank you, everyone, for watching. Please leave a rating and review for Monetary Matters on Apple Podcast and Spotify. And don't forget to subscribe to the Monetary Matters YouTube channel. Thank you. Thank you, everyone, for listening. Remember to check out CAIA.nxt to level up your knowledge of alternatives today. Visit the link in the description to get a 10% discount and learn about what's next for your clients.